Welcome back to the deep dive. So we have been analyzing a series of sources that, well, they present a number so immense it sort of forces you to fundamentally reconsider the entire global AI investment landscape.
It really does.
We spent a lot of time discussing U.S. technological leadership, the current investment ratios. But our material today focuses on this dormant financial giant.
A $22 trillion financial force just poised to accelerate domestic AI growth in China.
It's incredible.
Yeah, the conventional narrative, it always fixates on pure technology investment, right? Who bought more GPUs? Who has the best R&D lab?
Right, the hardware race.
But that view is just, it's too narrow. Our deep dive today is all about connecting this almost unbelievable pool of latent Chinese capital with the rapidly increasing performance of their homegrown AI developers.
And the moment those two things connect.
The moment those two forces fully connect, the balance of global power, it just shifts dramatically. It stops being a pure technology race and becomes an economic efficiency battle.
Okay, so let's unpack this immediately. Let's start with that staggering figure that really anchors this whole discussion. The number is $22 trillion. That is the current estimated value of household savings just sitting in China.
It's hard to even conceptualize.
It is. And if you're listening and you think that sounds massive, you are absolutely right. Our source material emphasizes this figure is over 1/3 of the total value of the entire U.S. stock market.
It's an almost unimaginable amount of money, and it's the key context here. Historically, Chinese households have been, well, incredibly conservative with this money.
Right. They don't really play the markets in the same way.
Not at all. They store their wealth primarily in things like housing assets or, low-yield bank accounts. We're talking about only about 5% of those massive savings typically being invested in volatile financial markets.
So stocks, bonds, that sort of thing.
Exactly. This low participation rate has kept all that capital dormant. It's a massive investment gap that the U.S. market has, frankly, never had to compete with.
So, okay, the obvious question then is, why would that habit change? I mean, why is the timing right for this capital to move now when it's sat idle for decades?
Well, the sources point to two main catalysts, really, that are creating the shift. First, you have the widespread challenges and, frankly, instability in the Chinese real estate sector.
Which has been a huge story.
A huge story, and it's severely eroded confidence in that traditional store of wealth. So savers are actively looking for alternative, higher growth places to put their money to just maintain their purchasing power.
So they're being pushed out of their comfort zone.
They're being pushed out, and at the same time, they're being pulled in. The government is reportedly implementing policy shifts. We're seeing talk of tax incentives, regulatory easing, specifically designed to encourage this capital to flow out of bank accounts and into domestic financial assets.
Basically steering it toward areas like technology.
Precisely.
So you have hundreds of millions of households actively looking for new avenues for their savings. And then you have the government basically building the on-ramps to the public markets to welcome them. That conservative 5% rate, it starts to look really vulnerable.
It's extremely vulnerable, and the math here is just, it's brutally effective. It showcases the financial leverage China holds.
Okay, lay it out for us.
If Chinese households were simply encouraged, through policy and market necessity, to increase their investment in domestic financial markets from 5% to just 10%.
So just a 5 percentage point increase.
Just a 5 percentage point increase. That surge of additional capital flowing into domestic investments, including high-growth areas like AI, would total $1 trillion.
$1 trillion. That wasn't previously in the competitive landscape, suddenly available for domestic developers.
Exactly. The sheer financial power needed to rapidly accelerate China's AI growth is already sitting there, just waiting for this catalyst.
So the financial fuel is there, ready to be ignited. But as we know, capital tends to follow capability. What's the technology that's actually attracting this potential investment?
That's the perfect transition, because the market infrastructure is lining up right now precisely because the technological maturity is, well, it's rapidly approaching parity with the U.S.
Even though the U.S. still holds the lead in overall investment.
It does, but the critical shift that's highlighted in the source material is the open source dominance that's coming out of China.
Yes. The focus on models like Qwen is really striking. Our sources note that Qwen is becoming highly competitive, performing on par with many top proprietary models globally.
And it's getting real market traction.
It really is. It is dominating global open source downloads and usage right now. Why? Why this model specifically? What's making it gain so much traction over the alternatives?
It really just speaks to utility and accessibility for the global developer community. Qwen, which is primarily developed by the tech giant Alibaba, it functions as this highly optimized general-purpose large language model.
Meaning it can do a bit of everything.
A bit of everything, from complex enterprise automation tasks to creative coding. It's highly versatile, and developers are choosing it over comparable U.S. open source models because its training has been so efficient, which results in superior performance for its model size.
And that efficiency is the key.
That superior efficiency is what leads us directly to the critical economic point we need to get into.
And crucially, this software dominance isn't happening in a vacuum, right? I mean, it's projected to grow, especially as the sources point to China becoming much more competitive in domestic chip manufacturing.
If you can control the hardware supply chain you need to run the software that is already dominating global downloads, you create a self-reinforcing, fully integrated domestic AI ecosystem.
And investors see this coming.
Oh, they aren't waiting. They're jumping in now to capitalize on this alignment. I mean, the public market activity, it's clearly signaling that this growth is already fully underway.
That's right. We are seeing a major wave of IPOs, which confirms that capital is starting to find its domestic targets. We have specific examples from our source material. Chinese AI companies like Zhipu and MiniMax, they recently issued successful IPOs in Hong Kong. And to provide a bit of context for you, Zhipu is known for its advanced enterprise LLMs. It's competing directly with models like OpenAI's.
And MiniMax is more on the creative side.
Exactly, more creative and consumer-facing applications.
And this is just the vanguard. It's just the beginning. Dozens of other key high-profile AI companies, including DeepSeek and Moonshot, both highly touted generative AI firms, have either submitted or are actively considering filing for Hong Kong IPOs.
So this is the market infrastructure being built out right now to absorb that massive potential $1 trillion capital injection from households.
And the speed of it all leads us directly into the core competitive threat that's facing U.S. AI dominance.
Okay, let's zero in on that. The core economic threat, because this is where the dynamic really flips. If the quality of these Chinese AI models is becoming, let's say, near comparable to U.S. models, what is the single knockout punch they deliver to businesses globally?
It all comes down to cost efficiency, operational expenditure. The central competitive advantage is that these developers can market far, far less expensive models that deliver nearly equal quality to the top U.S. proprietary models.
And to really understand the scale of that disruption, you have to look at one technical term in particular.
Yes, inference cost.
Let's quickly define that for the listener, because it really is the hinge for this whole argument. What exactly are we talking about when we say inference?
So think of inference as the cost a business pays every single time they use the AI model to generate an answer.
Okay.
Whether it's running a search, summarizing a huge data set, or running a creative design prompt. It's the operational cost of running the AI system. It's the gas you put in the car every time you want to drive.
Got it. So what is the cost differential here? Why is it so vast?
The specific quantitative detail from the source material is it's truly disruptive. These Chinese models could potentially run at just 1/10 of the inference cost compared to proprietary U.S. models.
1/10.
1/10. And this huge differential is reportedly due to highly optimized model architectures and China's anticipated advantages in energy and specialized domestic hardware.
1/10. I mean, that's not a slight advantage that you can just absorb with brand loyalty. That is a fundamental industry repricing event.
It is.
But here's my skepticism. Is near comparable really enough to displace the cutting-edge U.S. proprietary models?
I mean, they arguably still hold a marginal quality lead. Doesn't the market usually favor that slight edge in quality, even if it comes at a higher price?
That is the critical historical question, and we have to answer it. And if you look at the past several decades, the answer is very often no. To connect this to the bigger picture, we really need to look back at the historical precedent of, say, U.S. manufacturing in the late 20th century.
Yeah.
So you're talking about the massive outsourcing wave that basically hollowed out large parts of the U.S. manufacturing sector because production just moved to places with lower labor and operational costs.
Precisely. That shift happened because U.S. businesses and investors are simply not averse to moving operations or capital to environments where lower costs translate into significantly increased profit margins.
It's just business.
In the 1990s and 2000s, the choice for investors was clear. It was profitability versus national loyalty, and profitability won, hands down. It drove huge amounts of U.S. capital and jobs across the Pacific.
And economic inevitability, really, dictated by quarterly returns, even with the social cost to the domestic economy. So why would the adoption of AI models, which are a pure software operational cost, be any different?
It wouldn't be any different. If the Chinese open source AI ecosystem takes off, offering models at 1/10 the inference cost, the operational profitability of every single business relying on that tech just skyrockets.
And for the average investor,
For the average American institutional or retail investor, the motivation is pure economics. They will opt for earning the higher yields offered by those far more profitable investments in that low-cost Chinese ecosystem. The capital flows where the highest return is, regardless of geography.
so the U.S., which has been the technological leader, could paradoxically see its own capital migrate across the Pacific, searching for better returns because of this overwhelming cost difference.
Yes.
That creates an extremely high-stakes scenario for the American AI giants. What does this mean for the big names in the American AI space, specifically?
Well, the timing here is not accidental. It feels like a strategic challenge. The U.S. tech giants are preparing for their own moments of massive capital generation, and they're going to need every available dollar.
Right. Let's remind the listener of the specific timeline that's highlighted in our source material. Major U.S. companies like OpenAI, Anthropic, and other American AI developers are preparing to issue their own massive IPOs in the very near future.
Specifically targeting that critical 2026 and 2027 window.
And those IPOs, they rely on the availability of just vast amounts of global investment capital to succeed and to lock in those multi-billion-dollar valuations.
Of course. But if that $1 trillion latent Chinese household savings pool is suddenly active now and it's driving up the yields of Chinese AI IPOs, it creates this massive global gravitational pull on investment dollars.
Right before the U.S. giants go public.
Right before.
Which means the U.S. giants could find themselves in a capital competition they were not expecting, forcing them to potentially accept lower valuations.
It's a real possibility. If significant American dollars, and that includes institutional and retail investment, if they migrate now to chase the higher yields offered by this rising low-cost Chinese ecosystem, then giants like OpenAI and Anthropic could be left scrambling.
Scrambling to compete for investment capital during their own critical IPO phases in 2026 and 2027.
This suggests a potential major reversal in the investment ratio. We are so accustomed to capital constantly flowing into U.S. tech. Now we are discussing a scenario where capital may flow outward from the U.S., drawn by superior economic efficiency and higher yields overseas.
The financial battle for AI dominance isn't just about R&D spending today.
No, it's about which market structure offers the most attractive return on investment tomorrow.
So let's just quickly recap this deep dive for you, the listener. We've established that a massive, currently dormant pool of capital, that $22 trillion, is aligning perfectly with rapidly advancing low-cost domestic AI technology.
Technology exemplified by models like Qwen and a growing competitiveness in chip manufacturing.
It is the perfect storm, really. Financial capacity meeting technological parity, ready to challenge U.S. AI dominance based on pure, undeniable economic efficiency.
And a 10-to-1 inference cost advantage. It's a powerful combination.
It is. So here is our final thought for you to explore on your own time. If this economic challenge to U.S. dominance is so significant, why are the mechanisms, the scale, and this IPO wave in China not constant front-page headlines on every major financial news outlet?
That's the real question. And the source material suggests a real possibility that some major financial news providers may be, well, reluctant to candidly report the full strength and accelerated growth of the Chinese AI ecosystem.
So the question for you, the listener, is this. Will American investors have a complete and accurate view of the global competitive pricing structure and the magnitude of this capital migration before they're asked to assess the massive IPOs from U.S. giants like OpenAI and Anthropic in 2026 and 2027?
You need to know both sides of the balance sheet to make informed decisions. Information asymmetry could become a major factor in that 2027 AI investment landscape.